How's it going everyone, Mario here. In this video we're gonna go over a simple process to vet stocks which are worth adding to your watch list on your own for potential trades down the road instead of being reliant on someone else. Think of it as a game which has multiple levels on it. You need to complete the first level in order to get to the second one. This process involves two of such levels. The first level involves focusing on stocks which have positive momentum in both shorter and longer time frames, aka multiple time frame analysis. We are going to work on building our own system along the way, a set of rules which we won't violate regardless of what happens, regardless of how we feel. Let's start with step 1. Always start with the dominant time frames, aka daily. First things first, if you want to buy a stock, you need to make sure that the stock is in an uptrend. There is a pretty easy way to get the momentum of the stock. Go to the indicators and add the 20, 50 and 200-day simple moving averages. Note that we are only going to use these three moving averages when we are looking at the daily time frames. Once you added these three moving averages, you need to be looking out for which direction they are sloping at. It's not enough for the price to trade above these three moving averages. We need these three moving averages to be sloping positive. Note that you will only be seeing positively sloping 20-day, 50-day and 200-day moving averages if the stock is having a series of higher highs and higher lows for the last 20, 50 and 200 trading days. So last week we entered a trade on IBM. You can see on the daily chart, the blue line is the 20-day moving average, the yellow line is the 50 and the red line is the 200. The 20-day moving average is positively sloping, pointing to the upside. The 50-day moving average is positively sloping. The 200-day moving average is also positively sloping. The stock is trading above all these three moving averages, which technically means the stock is in an uptrend. So let's go over another example. The ticker symbol is FAST. Go to the daily time frame. The 20-day moving average is sloping to the upside. The 50-day moving average is also sloping to the upside. The 200-day moving average is also sloping to the upside. The stock is in an uptrend. Pretty simple, isn't it? Do not confuse being simple with not being effective. When it comes to technical analysis, sometimes being simple is one of the most sophisticated things you can do as a trader. Sometimes you will notice a stock above the positively sloping 20-day moving average, while the 50 and 200 are still declining. Take NEO for example. The 20-day moving average is flat. The stock is trading above the 20-day moving average, but the 50-day and 200-day are still declining. All it tells you is the momentum for the last 20 days is positive, but for the last 50 and 200 days, the momentum is still favoring the sellers. The dominant time frames are still to the downside. The stocks like ARRY falls into the same category. Positive 20, but 50 and 200 are still declining. Sometimes you will see stocks with both 20 and 50-day moving average positively sloping, with 200-day moving average declining. Take the stock CVX for example. It has positively sloping 20-day moving average, positively sloping 50-day moving average, but declining 200. All it's telling you is the momentum for the last 20 days is positive, momentum for the last 50 days is positive, but the dominant 200-day moving average, the momentum for the last 200 days is still declining. The stocks like BABA falls under the same category. Sometimes you'll see the stocks which has positive 200-day moving average with both 20 and 50 still declining. Take the stock CCJ for example. We have the declining 20-day, declining 50-day, but the 200-day moving average is still positive. I have a rule of thumb. If I go to the daily chart, if I see the 50 or 200 is declining or sloping to the downside, I am not interested. Not because I can't make money by trading them to the upside, but the odds of me doing the same repetitively and avoid massive drawdowns and achieve market outperformance in the long run goes down significantly. Would much rather buy the strength rather than getting involved in stocks with momentum declining for the last 50 or 200 days, aka dominant downtrends. If this is the case, stock goes immediately to the garbage bin and I am not interested on the same yet. For the first step, start with the daily charts. When you see a declining 50-day moving average or declining 200-day moving average, that stock is not worth taking the risk by putting your hard-earned money into. There's a lot of great looking setups out there, and this is not one of them. So when the 20 is positive, 50 is positive and 200 is positive, then and only then you move to the smaller time frames, which is step number 2. So before we move into step number 2, note that you don't need to catch the bottom on the stock to make money. You just need to be in the direction of the trend. We are retail traders and we cannot support the price. Let the institutions take the risk for you. Let them buy at these untested support or resistance levels. Let them show you that they are interested in a stock and let the stock show you the strength. We wait for the strength and then we buy the strength instead of trying to call the bottom on a stock which has been declining on a daily basis and which the institutions have been selling into on a day-to-day basis. So now let's move on to step number 2. If a stock was having positive 20, 50 and 200-day moving average on the daily time frame, then and only then we move to the second step, moving to the shorter time frames, aka 15 minutes. Move to the 15-minute time frame, and for this time, disable the 20, 50 and 200-day moving averages here. We don't need those three when we are looking at the 15 minutes. Go to the indicators and select simple moving average or moving average simple depending on which charting software you're using, and change the length of that moving average to 130 SMA, 130. This 130 SMA on the 15-minute time frame is what we call 5-day moving average. So think about it this way. From Monday to Friday, markets are opened for 32.5 hours, which is 1950 minutes. If you want to calculate the momentum for the last 5 trading days, you divide that 1950 by the time frame which you're looking at. In case of 15 minutes, it's 1950 divided by 15, which will give you that 130 SMA. Add the simple moving average and change the length to 130. Once you have this on your chart, we need to be looking out for 2 major things. Number 1, is the price trading above the 130 SMA? And number 2, is the 130 SMA sloping to the upside? Note that we are only going to this step number 2 if the daily charts are still in an uptrend, which is about 20, 50 and 200. After looking at the daily, and now you go to the 15-minute time frame and you see the price of the stock trading above the 5-day moving average and the 5-day moving average is sloping to the upside, then and only then you're going to go over considering and potential entry on the same stock down the road. This is where you're going to add all these support or resistance levels. This is where you're going to add all these where should I enter and where should I exit, and the planning stages. All these comes to place right here only after these 2 conditions are satisfied. Now let's go over some examples. Take IBM. The daily charts is still in an uptrend about 20, 50 and 200. Now we move to the next step, which is the 15-minute time frame and adding the 130 SMA to the charts. You can clearly see the 130 SMA is not only positively sloping, but the stock price is also trading above it. So this satisfies the rule number 2. So let's go over another chart. Check out FAST. The daily chart is above the positive 20, 50 and 200-day moving average. And when I go to the 15-minute time frame, the stock is not only trading above the 5-day moving average, but the 5-day moving average is also sloping to the upside, which satisfies both of our conditions. Sometimes the daily charts will still be in an uptrend, but when you go to the 15-minute time frames, you'll see the stock not satisfying the both of our sub-conditions, which is either the stock will be trading under the 5-day moving average or the 5-day moving average will be declining. Take the stock for example. The ticker symbol is NXPI. You can clearly see the daily charts are still in an uptrend. It has a positive 20, positive 50 and positive 200. But now, when you move to the 15-minute time frame, you can see the price trading under the 5-day moving average, and the 5-day moving average is flattening out. All it's telling you is the momentum for the last 5 trading days is trying to fade away, it's trying to shift. When you see this, well, all you gotta do is wait for it to set up, wait for the price to get back above the 5-day moving average, and wait for the bulls to retake the strength. As mentioned earlier, our job as a trader is not just to do guessing games by buying stocks at random untested levels. As a trader, you need to be looking out for these high probability, low risk entries so that we can capture 3 times our stop losses and profits to the upside. So to recap, the dominant time frames need to be in an uptrend. How do you find it? Well, you add these 3 moving averages, 20-day, 50-day and 200-day simple moving averages, and you need this 20, 50 and 200 to be positively sloping, and you need the price to be trading above all these three moving averages. And if this condition is satisfied, then you move to step number 2. Go to the 15-minute time frame and add the 130 SMA, and note that you have to disable the extended hours while doing it. The price should be trading above the 5-day moving average, and the 5-day moving average should be sloping to the upside. Only if these two conditions are satisfied, we are going to be looking out to plan for that particular trades. This is where we draw the support levels. This is where we're going to start looking for potential entry, stop losses, position sizing, position management, and all those good stuffs. I hope this video was helpful. Leave a like, subscribe, and check out the Patreon. Link is down below in the description. As always, take high probability trades, manage the risk wisely. I'll see you guys in the next video.